Alright, in this video we will discuss about most important thing before you enter in this market. First, resistance. What is a resistance? Resistance is a level above price where price has rejected to in the past and can potentially react to again in the future. For example, suppose price hit this level and reverse back. So once price reject this point, if price goes up again to this level, it is a probability again react, or you can say it may bounce from this area. So that level called resistance. What is a support? Support is a level below price where price has react to in the past and can potentially react to again in the future. For example, price hit this level, again bounce from this area, and when price are approaching to the level, it is a probability to bounce again from this area. So this level called support. What happen when price break above resistance? When price break above the resistance now becomes support, as it showed below the price. Now you can see here price hit and reverse back and act as a resistance, and price hit and reverse back act as a resistance. Now in this area price broke this resistance line. Now this resistance line become as a support. Now here you can see it act as a support. What happen when price break below support? When price break below support, that support now become a resistance. Now here you can see price hit and reverse back act as a support. Price break this supporting line. Now this supporting line becoming a resistance line here. Here you can see price create a new low and act as a resistance. Why support and resistance are important? If price has react to this area in the past, it can potentially react to them again in the future, as I shown earlier. For example, suppose here is a resistance line. First, price hit and reverse back act as a resistance, and when price approach this supporting line, there is a potential that price may react again as a resistance, and we can enter in this market for short. So that is why support and resistance are important. Support and resistance rules we follow. First, swing high and swing low, meaning the highest and lowest point price reached recently. So for example here, swing high and a swing low, swing high, swing low. We connected. Now this is called resistance and this is called support. Number 2, multiple touches and rejection of an area, the more better. So in this area price hit, reverse back, hit, reverse back, hit, reverse back, or hit, reverse back. Now in this area we have seen multiple touches point are there. So this area are more reliable. Now here you can see as a support price hit, reverse back, hit, reverse back, and multiple rejection from this area. So this area are more reliable. Has act both support and resistance. Now in this area, so here you can see this portion act as a resistance, and from this area to this area act as a support. So when price pull back to this level, it is a probability to bounce again from this area. Why this level is important? Because this level is respecting as a support and as a resistance. The move away from this area drastically. Now in this area here you can see price hit and reverse drastically. So this area is most important. So in this area here, I can see price hit and reverse from drastically. This area are most important. Last, respecting recently. Now in this area, now I can see price are respecting recently, and here I can see price are respecting recently. So this area are more important. Now most of the people are asking me, do you just jump into a trade every time price reach the support and resistance? So most of the new trader, now here I can see price hit and reverse back, act as a support, price hit and reverse back, act as a support. Now we have seen multiple rejection, and most of the new trader are asking me, when price hit this supporting line, can I go for buy again? No, we can't enter when price hit the support or resistance level. So we need a confirmation. So let's see here. Suppose price hit, reverse back, hit, reverse back. Now price are approaching in this area. So in this area we need a buy confirmation. Then we enter in this market. Another important thing, we need candlestick pattern. So we need a major candlestick pattern, and that candlestick pattern should appear in a right place like a resistance or supporting line. So that is a additional entry point. Okay, trending market versus ranging and sideways market. Now in this area you can see price are running in a downtrend. So here you can see this is called trending market, and right now here you can see price there are no trend, and this is called sideways market, and another here in this area. So you can say this is the uptrend. So you must find out what is the market range, what is the market condition right now, so before you enter in this market. All right, when price are running in a downtrend, so you go for short, and when a ranging market, it is better to stay away from the market, and when market are running in an uptrend, so you go for buy. So later we will discuss when to enter in this market. Now first we must know the trending market. In a heavily trending market, you have to be very careful when trying to trade counter trend. So most of the people are doing big mistakes. So when price are running in a downtrend, so they are buying, right? People are expecting that price will bounce from this area, they are placing buy or some confirmation. Here you can see bullish signal, people are expecting that price will reverse from this area, so they are buying. So it is most important thing when price are running in a downtrend, when to buy. So at that time we are using different trading strategies. So later we will definitely discuss when to enter in this market. Ranging or sideways market. In a ranging or sideways market, trading both long and short position is effective as neither bull or bear are control of the dominant trend. So when price are running in a sideways market, so we are not looking for enter in this market. Trend line. Trend line act as a form of support and resistance, except that they are drawn along trending swing low and swing high. So here you can see this is the swing high, swing low, swing high, and a swing low, swing high. So when we connect this swing high and swing low, so we have seen the trend line. A trend line break signal and confirm a trend change. Now you can see price are creating lower low, lower high, and a lower low, lower high. So we connect that swing point. Here you can see we just connect that swing point and drawn a diagonal trend line. So after that, here you can see price broke this trend line, called it is a breakout. So this area called we are confirming that they are going to change the trend. the 50 EMA. So basically we use 50 EMA. The 50 EMA is a most widely used EMA by trader. The 50 EMA act as a dynamic support and resistance and trending market. Now you can see this is the 50 exponential moving average is act as a support and resistance. Now in this area, so in this area 50 moving average act as a resistance. Now you can see act as a resistance. So when 50 moving average broke, now price changed the trend. So in this area trend was running in a downtrend, and when price break 50 moving average, they placing a uptrend. Now 50 moving average act as a support. When price stay in between the 50 moving average or near 50 moving average, so what happened? So 50 EMA running through the price, or it called ranging market or sideways market, or most of the people are say consolidations. Now here you can see this is the 50 exponential moving average, and price running in between this 50 moving average. So when price are running in between this 50 moving average, it is called sideways market, and we are avoiding to trade in this market. How we use 50 exponential moving average? Basically we are using a 50 moving average in a two way, one called confluence area or another support and resistance. Now you can see this 50 moving average, here you can see this is the resistance, resistance, resistance and a resistance, and now this resistance line becoming a support, and exactly at that time 50 moving average also forming as a support. So this area called confluence area, so we are using as a confluence area. And another method we are using as a support or resistance. Now in this area 50 moving average act as a support, act as a resistance, and here you can see act as a support. So we use as a support and resistance. Fibonacci tool, we are using 61% retracement or 50% retracement. So let's see here, price are running in an uptrend and they create a wave, and we are looking for buy after giving a retracement, or we can say pullback 61% or 50%. So exactly when price retrace to this level, so exactly we are looking for a bullish confirmation, and at that time we are using moving average or another support and resistance. So later we will discuss. So remember, basically we are using 61% retracement and 50% retracement. For example, here you can see price hit and reverse back, and hit and reverse back. This area act as a resistance. Now you can see it's a resistance line, because price are rejecting again and again. We have seen multiple rejection. Now you can see after breaking this resistance line, price create a new high, again price pull back. Now in this area, if we calculate this wave as a impulsive wave, so if we draw Fibonacci, and I can see this area retracement 61%. Now I can see in this area 61% retracement. So now this area called confluence zone, because this area there are resistance and Fibonacci supporting line both are appearing. Another example, here you can see we are using 50 exponential moving average EMA, another support and resistance, and we are using Fibonacci. So let me show you here. So price gone up, create a new high and pull back. Now you can see there are multiple rejection act as a support and withdrawn as a supporting line, and at that time there are 50 exponential moving average, this red line, have you seen 50 exponential moving average, and when we connect this wave by using Fibonacci, now you can see there are 61% retracement, and this is called high probability trade. candlestick, we are looking for a momentum loss candle. So let me explain here what is the momentum candle. So first here you can see we have seen this is the big candle, and another followed by a smaller candle, followed by a even smaller candle, and followed by even smaller candle, and finally we have seen long wick candle. So you can say long wick candle like that. So most of the people used to say like inverted hammer, doji candle, whatever. So we use here momentum loss candle, because here you can see it means price starting from this area, pull up, buyer was dominating, but finally bear are dominating in this area and close in the same time and it look like that. So this is called momentum loss candle. So once they appear, we are looking for short. I hope you enjoyed this video. If you like this video, please like and subscribe, and next video we will discuss pattern confirmation. We will combine with a support and resistance line. There will be a various type of pattern. So thanks for watching.